Peer-to-peer platforms are on the ascendant as an alternative way for people to borrow money and for investors to seek higher returns. Only a decade old, these platforms really took off after the financial crisis, when banks reined in lending and people started to go online for financial services.
Peer-to-peer platforms match lenders directly to borrowers. As online portals with few overheads, these platforms can charge borrowers less and pass back more to investors. By comparison, banks have layers of bureaucracy, charge borrowers more to cover the costs of their branch networks, and it's not entirely clear who investors are lending to.
But challenges lie ahead for the fledgling industry, from a rise in interest rates to the emergence of new, riskier platforms.
In terms of the UK peer-to-peer industry and how long it's growing, I think the first peer-to-peer platform here was Zopa, which set up in 2005. So in fact, the UK is the original birthplace of peer-to-peer, you could say, globally. So it's been around for about 10 years in the UK.
But the growth of peer-to-peer platforms really started taking off in the last few years, in line with the increasing use of digital financial services. Figures show there were 9.1 million uses of mobile banking applications a week in 2012, which rose to 18.6 million in 2014.
Since the crisis, it has been difficult for people to get access to credit, both individuals and small businesses. Banks would like to do this. They would like to be lending to the individuals and small businesses, but due to sort of regulatory pressure, they've been forced to sort of cut back their lending.
Small businesses, like Mark Thompson's Funky Junk in North London, a supplier of music equipment and recording studios, are using peer-to-peer for the advantages it offers over the traditional banks.
It just seemed an extremely obvious and logical way forward in the internet age to get away from a middleman who was doing very little other than introducing 10 layers of bureaucracy and 11 layers of charges, and deal directly with people who wanted to get a good rate of return on their investment to supply me with the modest finance we needed to fund that project.
For borrowers, gaining funding is often faster and cheaper than through the traditional route of a bank.
The process was simple. It was scaringly simple. It took several weeks from beginning to end, whereas at that stage it was taking 6 weeks to get the bank manager to return a phone call, which I think in some ways sums it all up, that the banks have become complacent, the banks have become frightened of giving any kind of an answer until they're really kind of put on the spot. And it was a very simple proposition presented by a business with lots of security, with strong cash flow, with plenty of resources. In many ways it was a no-brainer.
But there are risks involved. For investors, one of the risks is that peer-to-peer is not covered by the Financial Services Compensation Scheme, which provides a safety net for deposits of up to £85,000. And now the Financial Conduct Authority has said it will clamp down on any platforms that do not provide clear marketing material, amid concerns that some are mis-selling their products as risk-free savings accounts.
There are some risks, of course, but I happen to think they're quite manageable. The primary risk for the lenders really is around the credit risk, actually, of the borrowers. But I mean, thankfully, we've got quite a lot of banking data, which you can refer to understand how much risk you're taking with consumer finance and SME lending. And actually, when you look at the historical backdrop in terms of credit risk historically, the risks around peer-to-peer lending, if it's done properly, are very manageable.
While some platforms aim to diversify risk by spreading investors' money across loans, others have backup funds in place, which are created through a fee charge to borrowers.
The way that we make sure that the risk is diversified, if you're a saver, is that we have this thing called the provision fund. So every borrower at RateSetter pays into the provision fund. So we've done nearly 70,000 loans. Every single one of those borrowers has paid into that fund. In the event that your borrower can't pay back, the fund will recompense you. So the effect of this at RateSetter is that you may have 30 borrowers. The average amount of borrowers per saver is 34. You may have 5 borrowers, you may have 100. But in the end, your risk is to the provision fund, and the provision fund has 70,000 borrowers. So actually, your risk is diversified across the whole loan book.
Even though the industry faces challenges, peer-to-peer platforms are gaining traction among investors and borrowers alike. Banks are even starting to collaborate with some of these platforms as a way to serve a customer base they might otherwise exclude. As long as investors are made aware of the risks, peer-to-peer platforms can continue to cement their status as a viable alternative to mainstream bank lending and push further in towards mainstream financial services. Emma Dunkley, Financial Times, London.